Imagine watching retail investors and huge hedge funds just absolutely panicking, dumping their gold holdings because interest rates are high.
Right.
But then you peek behind the curtain and see the institutions that actually control those interest rates, the central banks.
Yeah, the ones pulling the levers.
Exactly.
Yeah.
And they're quietly treating this massive panic like a Black Friday sale, buying up that exact same gold at record levels.
Welcome to today's deep dive. Before we get going, please make sure to like the video, subscribe to the channel, and comment below with your opinion on the markets right now. It is Friday, June 19th, 2026, and I'm joined today by Senior Market Analyst Michael Anderson.
Good to be here.
Our mission today is to take a look at a freshly released stack of market bulletins, technical reports, and institutional forecasts. We are taking this violent, sudden shock in the precious metals market and tearing it down to the studs. Okay, let's unpack this. Because to make sense of what just happened, we have to look past the red flashing on the screen and figure out the exact mechanics of the sell-off.
Yeah, we need to diagnose the anatomy of the drop.
Right.
And we really need to emphasize the sheer velocity of that drop, too. I mean, gold didn't just drift lower. It plummeted. It bottomed out at $4,122 an ounce right around 1 in the morning before a rather anemic bottom buying attempt managed to drag it to a close at $4,155 by 1 in the afternoon.
Which is just a brutal $260 haircut in 2 sessions.
Right, exactly.
It's like the market was driving 100 miles an hour toward a rate cut vacation and someone suddenly yanked the emergency brake. But when I look at the silver charts, the proportionality is even more aggressive.
Oh, absolutely.
Silver lost about $8.20. It hit a low of $63.30 before closing out around $64.88. In the context of silver's typical trading range, an $8 move in 2 days is a structural earthquake. So, what's the mechanism there? Why does silver get punished so much faster than gold in these liquidations?
Well, what's fascinating here is that silver operates with this severe split personality in the market. And right now, both of those identities are under attack. It's experiencing what we call double pressure.
Okay, double pressure. Walk us through that.
So on the financial side, it trades as a monetary metal. So it suffers the exact same macro liquidation that hits gold when rate expectations shift. But unlike gold, silver is also a critical industrial component.
Right. Because of the green energy sector. Solar photovoltaics, electric vehicle manufacturing, all of that requires physical silver delivery.
Exactly. So when the market anticipates higher interest rates, they aren't just pricing in a stronger United States dollar, they are pricing in a contraction in global industrial growth.
Ah, I see.
Yeah, because high borrowing costs mean fewer factories expanding, fewer infrastructure projects breaking ground. So silver paper contracts are getting dumped by monetary funds, while simultaneously being shorted by speculators who are betting on an industrial slowdown.
Wow. But looking at the data in these reports, it suggests a silver lining. No pun intended there. If silver can manage to hold its ground in that $63 to $64 range, the underlying technical structure actually looks more resilient than gold right now. How is that even possible after an $8 drop?
Because of the physical market reality. Look, paper traders can dump silver contracts all day to adjust their risk models, but industrial manufacturers cannot run their assembly lines on paper.
Sure.
If the price drops into the low 60s, massive industrial buyers step in to secure physical supply at a discount. That creates a very hard floor based on inelastic physical demand, which, cushions the blow and keeps the macro technical structure intact, even when the paper market is screaming.
That makes total sense. The paper market panics, but the physical supply chain anchors it. Now, what actually triggered that panic? Because this $260 drop in gold didn't just come out of nowhere. It came directly out of the latest Federal Open Market Committee meeting in Washington.
Yeah, the Federal Reserve effectively altered the gravitational pull of the entire financial system in one afternoon. And the irony is they didn't even raise rates.
Right, they kept them completely on hold.
They did. But the messaging accompanying that pause was incredibly aggressive. If you look at the Federal Open Market Committee dot plot, 9 out of 19 Fed members are now telegraphing that they want to raise rates again before the end of this year.
Which is wild, because we went into that meeting with the market pricing in a 61% probability of a year-end hike. When the press conference ended, that probability had rocketed to 85%.
And that repricing is the spark that ignited this entire sell-off.
I want to push back on the math of that, though. The market went from a 61% chance of a hike to an 85% chance. That is a 24% shift in probability. Why does a mere 24% adjustment in the likelihood of a single rate hike cause institutional managers to liquidate physical assets so aggressively? It feels totally disproportionate to the news.
I mean, it feels disproportionate if you look at gold in isolation.
Yeah.
But institutional capital doesn't look at anything in isolation.
Yeah, right.
They operate on relative yield models. It fundamentally comes down to opportunity cost and risk-free returns.
The idea that capital flows to wherever it's treated best.
Exactly. Think of holding physical gold right now, like owning a beautiful unencumbered apartment building in a premium zip code. It holds its intrinsic value flawlessly over time. But right now, you have no tenants.
Okay.
The building generates absolutely zero monthly income. Now imagine the bank directly across the street suddenly announces they're offering a guaranteed risk-free 5% yield just to hold your cash.
Oh, wow. So the institutional landlord looks at their empty building and realizes they are effectively losing money by missing out on the bank's guaranteed yield.
Precisely. And when the Fed signaled this hawkish shift, two things happened instantly. The DXY, the United States dollar index, surged to 100.77, its strongest week in a month. But more importantly, United States Treasury bond yields spiked.
The bank across the street.
Yes. Treasuries are that bank across the street. When sovereign bond yields jump, portfolio managers are mechanically forced by their risk models to reallocate. They sell the non-yielding asset, gold, and flood that capital into the high-yielding risk-free treasuries. The 24% probability shift triggered an automatic reallocation of hundreds of billions of dollars.
So what does this all mean for this safe haven thesis? Because historically, gold isn't just an alternative to bonds, it is disaster insurance. And frankly, the geopolitical landscape outside of the bond market is still incredibly volatile. Why isn't the ongoing global conflict counteracting this yield pressure? I mean, it feels like the market has entirely stopped pricing in geopolitical risk.
You've identified a classic symptom of market myopia. Right now, institutional attention is hyper-fixated on the dollar and the Fed to the exclusion of almost everything else.
Really? Everything else?
Pretty much. The market is actively devaluing geopolitical risks because they haven't seen a massive supply shock materialize recently. They look at the recent United States and Iran detente and cooling crude oil prices, which obviously helps lower long-term inflation metrics, and they decide that geopolitical premium is no longer necessary.
But isn't that dangerously naive? Are these billion-dollar funds actually ignoring the very real ongoing tensions in places like the Strait of Hormuz just because Jerome Powell talked tough into a microphone?
Well, they aren't ignoring it entirely, but they are compartmentalizing it. The algorithms currently driving the trade are heavily weighted toward yield curves, not news headlines. But our sources highlight a critical caveat. Those geopolitical tensions in the Middle East haven't vanished, and they are currently acting as the invisible floor, preventing an absolute freefall.
Oh, okay.
If the global landscape were entirely peaceful right now, without the underlying threat to energy supply lines, gold wouldn't have stopped at $4,122. It would be testing sub $3,800.
Wow. So the lingering threat of a supply shock is basically the parachute slowing the descent.
Exactly.
But looking at the technical data, it looks like that parachute might have some holes in it. The reports are glaring here. Gold is currently trapped below its 200-day moving average.
Which is the ultimate psychological and technical line in the sand for macro funds.
Right. And Goldman Sachs just reacted to that break by slashing their year-end gold price forecast from $5,400 an ounce down to $4,900. Reuters is explicitly warning that if the immediate support level of $4,100 breaks, the market will target a drop below the psychological barrier of $4,000.
Yeah.
How much of this is driven by actual fundamentals, and how much is just machines trading against machines once that 200-day moving average line was crossed?
A significant portion of this velocity is purely mechanical. When you ask why it drops so fast, you really have to understand how algorithmic liquidations work. Large institutional funds program their trading bots with hard-coded risk parameters.
Right.
The 200-day moving average is a universally recognized trend indicator. Many of these funds place automatic stop-loss orders just below that line.
So the moment the price dips a single penny below that line, a massive wave of sell orders triggers automatically.
Exactly. And when those sell orders hit the order book, they drive the price down further, which triggers the next layer of stop losses, and then the next. It creates a cascading liquidity sweep.
Wow.
It's not a portfolio manager sitting at a desk deciding the macro thesis of gold is dead. It's a computer executing a defensive liquidation to protect capital. That's why psychological barriers like $4,000 are so dangerous. They become self-fulfilling prophecies simply because of where the algorithms are told to place their orders.
Okay, so the paper markets are triggering stop losses, Goldman is slashing forecasts, and retail traders are bleeding. It feels like pure doom and gloom. But here's where it gets really interesting. When you cross-reference this technical panic with the latest survey data from the World Gold Council, the narrative flips completely.
It really does.
The actual smart money, the sovereign wealth funds and global central banks, they are doing the exact opposite of Wall Street.
This is the underlying contradiction that defines the modern precious metals market. While leveraged hedge funds are dumping gold based on short-term Fed dot plots, the institutions that actually control the global money supply are backing up the truck.
Yeah, the World Gold Council reports that a record-breaking 45% of central banks plan to actively increase their gold reserves over the next 12 months. Almost half of the world's sovereign banks are looking at this moving average breakdown and deciding it's a buying opportunity.
Yep.
But let me challenge that for a second. If central banks are accumulating record amounts of physical gold, why didn't that massive buy-side volume prop up the price? I mean, why did we still slice right through the moving average?
Because central banks do not execute their trades on retail exchanges or standard futures markets.
No.
They don't want to drive the price up while they're accumulating.
Oh, sure.
They operate primarily through over-the-counter dark pools or through the Bank for International Settlements. They're accumulating physical bars directly from refiners or other sovereigns in off-market transactions.
So they're quietly draining the physical supply behind the scenes, completely detached from
the paper pricing mechanisms. Precisely. In fact, sovereign accumulators love it when algorithmic panic crashes the paper price. It allows them to acquire physical tonnage at a massive discount.
Right.
Central banks do not care about a 24% shift in a 12-month rate hike probability. They are managing generational wealth. They are looking at unprecedented levels of structural public debt across the group of seven. They are hedging against the long-term weaponization of the United States dollar. The fundamental structural supports for gold haven't shifted an inch. Only the short-term cost of leverage has changed.
Even the Goldman Sachs report, which grabbed all the bearish headlines with that forecast cut down to $4,900, explicitly noted that their adjustment was based strictly on short-term macro caution. It was not a pivot to long-term pessimism. They still expect prices to be significantly higher than they are today.
That distinction is critical. The rapid, highly emotional, speculative fever that drove the market up earlier this year has broken. The momentum trade is dead. But the secular bull market, the long-term structural trend driven by fiat instability, is completely intact.
So we have a tug of war here. We have the crushing immediate gravity of the Federal Reserve and high yields, pulling the paper price down, fighting against the massive quiet accumulation by central banks providing a physical floor. If you are listening to this right now, looking at your own portfolio, how do you synthesize these conflicting forces? What is the actual playbook for navigating this specific environment?
The overarching mandate from every technical report we reviewed is a shift toward capital preservation. This is a highly volatile transition phase. If we connect this to the bigger picture, the absolute worst thing you can do right now is trade on emotion.
Right.
The primary warning from analysts is to avoid chasing strong pullback candles.
Let's talk about that specifically because I know the psychology there. If you're listening and you see the price suddenly spike upward by $50 after a massive drop, your instinct is probably to average down. You see a green candle and think, this is the bottom. I need to buy the discount before it recovers.
And in a high interest rate liquidation environment, that instinct will destroy your portfolio. That upward spike is almost always a dead cat bounce. It's a temporary recovery driven by short sellers buying back their positions to take profits, not genuine organic demand.
Oh, wow.
If you buy into that spike, the downward momentum usually resumes and you are trapped at a higher price.
The sources are also incredibly strict about leverage. They explicitly warn to avoid using high margin during this volatility. Why is leverage so uniquely toxic right now?
Because we are in a market reacting to unpredictable macroeconomic data releases. When the market is this tightly wound around Fed expectations, a single higher-than-expected inflation print can swing the price $60 in a matter of minutes. If you are highly leveraged, your broker's algorithm will automatically liquidate your account before you even have time to read the news headline.
Brutal.
Leverage removes your ability to survive the volatility.
So if we aren't chasing bounces and we aren't using leverage, what metrics should we actually be watching to know when the bottom is genuinely in?
You need to stop watching the gold chart and start watching the macro drivers. Keep your eyes on the DXY. Watch the yield on the United States 10-year Treasury. Monitor the Chicago Mercantile Exchange Fed expectations tool for shifts. And importantly, track Brent crude oil.
Oil, right, because of inflation.
Exactly. Energy prices dictate inflation data, and inflation data dictates Fed policy. If you see oil prices surging, expect the Fed to stay hawkish, which will keep pressure on the metals.
For those tracking the specific technical boundaries, the short-term watch zones are very clearly mapped out. Support is sitting precariously between $4,100 and $4,120. If that zone holds, the market can breathe and consolidate. If it breaks, the algorithmic selling likely accelerates toward $4,000.
Yeah.
On the upside, resistance is parked at $4,220 to $4,260. We would need to see a confirmed close above that resistance to signal a genuine structural recovery rather than just a temporary trap.
But what about the long-term holders? The people who aren't trying to trade the daily swings but want to build a position?
For long-term investors, the strategy shifts entirely from trying to time the absolute bottom, which is statistically impossible, to intelligent capital allocation. The recommendation is a disciplined averaging in approach.
You divide your allocated capital into tranches. You deploy a fraction at the $4,100 support. If the algorithms drive it down to $4,000, you deploy the next fraction. You use the volatility to build an average price over time, rather than gambling your entire position on a single entry point.
Makes sense.
Patience is your greatest asset right now. Wait for the upcoming United States economic data to confirm the Fed's trajectory before you commit fully.
Essentially, don't try to catch a falling knife, especially if you're borrowing money to do it. It's about letting the macroeconomic dust settle before you try to build a permanent structure. So looking back at the complete picture we've painted today, the Federal Reserve effectively threw a massive bucket of ice water onto a highly leveraged market. By signaling that rates are likely staying higher for longer, they sent the dollar and Treasury yields soaring. That triggered a massive opportunity cost reallocation, forcing institutional algorithms to dump non-yielding paper contracts, crushing gold and silver by hundreds of dollars in a matter of hours. We saw broken moving averages, liquidated retail accounts, and dramatically downgraded short-term forecasts.
It was a violent, mechanical realignment of market expectations. The paper market was forced to digest a high-yield reality it desperately wanted to ignore.
But beneath that surface-level technical damage, the long-term structural foundations haven't cracked. They're quietly being reinforced. Not by day traders or hedge funds, but by the relentless, record-breaking physical accumulation of the world's central banks who are happily using Wall Street's panic to hoard assets at a discount.
Which brings us to the ultimate paradox of this market. This raises an important question, and it is something every investor needs to deeply analyze before they make their next move. If the world's central banks, the very institutions that control global interest rates, the architects who literally dictate monetary policy and print fiat currency, are aggressively buying record amounts of physical gold while the rest of the market sells, well, what does that tell you about their true underlying confidence in the long-term purchasing power of their own money?
Wow. Yeah. That is the thought that completely reframes the entire narrative. We started by looking at a $260 drop and calling it a panic. But maybe the real story isn't the drop itself. Maybe the real story is that the people driving the global economic bus are the ones quietly putting on parachutes while telling the passengers that everything is fine. Thank you for joining us on this deep dive. Keep a close eye on the DXY and those yield curves. Remember your support zones. Stay endlessly curious. And above all, navigate these volatile markets with a cool head. Before you go, please like this video, subscribe to our channel, and let us know your thoughts in the comments. We'll catch you next time.